Hello everyone, welcome to another video. Earlier I made this video on revenue recognition standard HKFRS 15, and this is actually an extension to that video. In this video we will actually focus on step 1 of the revenue recognition model, that is about identifying the contract, right? So this standard actually talks in detail about what a contract is, what would be recognized as a contract when talking about revenue from customers. And in your exams, you can have questions where they would give you a situation either in section A or section B, and then you might have to apply this criteria here. And for example, they can ask you like whether that situation contains a contract or not, right? So that could be a very simple basic question from your examiner, and then you would have to apply as a student, as a test taker. You would have to apply. You would have to show your application of these 5 bullet points here in identifying the contract, right? So let's look into these individual points. So an entity shall account for a contract with a customer that is within the scope of this standard only when all, right? So you need to focus on this. All of the following criteria are met. So like all the criteria, so A, B, C, D, E, all of this should be met in order for the contract to be present, right? It's not like the company meets only A and B and does not meet C, D, and E. Then therefore, the contract may not be there. So bullet point A. So part A basically says the parties of the contract have approved the contract, right? So the parties involved in the contract have approved the contract either in writing or orally, or in accordance with other customary business practices, right? So in different countries, there could be different business practices, and that's what they are catering to. So your contract can either be written or oral, and it should be approved, right? So that's first requirement. The contract should be approved. It should be either in writing or oral or any other business practice, customary business practice that your country follows. Part B, the entity can identify each party's rights regarding the goods or service to be transferred, right? So basically outlining the obligations. That's what it says. Outlining the obligations, right? So you must have, there should be clear understanding of what the contract is basically about, right? What type of goods will be delivered, in what quantity, or if it's a service, then what type of service are we talking about, the scope of engagement, if like, for example, if it's an audit service, right? So auditors actually define that scope of engagement, right? So that should be clearly specified. The rights and the engagement and the scope should be clearly defined in the contract, right? So that's about rights. Point C is about payment, basically. So the entity can identify the payment terms, right? So payment terms is another important thing. Since we are talking about revenue from customers, it's about revenue, right? So company is going to receive revenue, or in other words, a payment for their goods or services when delivered, right? So that payment should be clearly defined in the contract. The contract should have a commercial substance, and they have defined what do they mean by commercial substance here. So commercial substance is basically defined in terms of risk, timing, or amount of the entity's future cash flows that is expected to change as a result of the contract, right? So basically, revenues do have like an impact on companies' financial statements, especially P&L, right? So revenue is shown on that income statement, and there's an impact. There's an impact on company's income statement, right? So that's what commercial substance is. And examiners can actually ask you whether the contract, like this could be a question in itself, right? So this could be a question in itself. Examiners can ask you whether the contract has a commercial substance, right? They can ask you this question, and then you would have to evaluate the commercial substance by looking at the case, while evaluating the risk, timing, or amount, right? So this impact on entities' future cash flows. If there is, then the contract has commercial substance. Then last point is about it is probable that the entity will collect the consideration to which it will be entitled in exchange for goods or services, right? So all it's saying is that when the company delivers goods or provides services, then company is expected, and it is probable, right? So this is another key accounting term. So I would say this is a key accounting term, So it should be probable. It should be probable that the company is going to receive, entity is going to receive that money by after providing those goods or services. So how do you define, like they have also, they have defined, or they have explained, the standard has explained here, in evaluating whether collectability of an amount or consideration is probable, right? So they have defined whether it's probable or not. So you have to look at it. An entity shall consider only the customer's ability. So you look at the ability of your customer and intention to pay that amount of consideration when it's due, right? So that's what you look at. It's probable. So for probable, so for the cash flow to be probable, you look at two things: the ability and the intention of your customer, right? So you are expecting that your customer, is a nice customer and he's going to pay you. Your customer will pay you. Then the amount of consideration to which the entity will be entitled may be less than the price stated in the contract. So this last part is basically talking about discount, right? So it's not necessary that company will receive. So let's say it's $100 transaction. The company is expected to receive $100, but the company can give you a $5 discount, right? In order for, just to give you an incentive, give the customer an incentive to pay maybe a little earlier or on time. So in other words, the contract, you should have received $100, but there was a discount given to you, and therefore the company will only receive $95 from its customer, right? So that's what the last few lines of Part E basically tell you. Let's look at other paragraphs in the standard. So I will not cover all the paragraphs in the standard, but if you want, you can actually read them. I will only talk about main paragraphs that from where there could be a potential question on your exam. Right. So this paragraph here talks about enforceability and the rights and obligations. Right. So you can read paragraph 10 on your own. So paragraph 11 is basically talking about, whether, contracts can have different durations. So what you do where there is no fixed duration, or, on auto renewals, basically automatic renewals, right? So what you do and how do you account for that? So that's what paragraph 11 talks about. Then we have paragraph 12, which basically is about what happens if none of the party, so a contract. So when does a contract, so this is actually an important paragraph here. So for the purpose of applying this standard, a contract does not exist, right? So when does a contract do not exist? That's what it's talking about, right? So first part is, of course, the company needs to meet that 5 criteria above, as we discussed earlier. But then there's this additional thing here, that the contract does not exist if each party contract has unilateral enforceable right to terminate a wholly unperformed contract without compensating the other party or parties, right? So this is a business situation, right? This is a business situation. Now you can have a contract. The company can have a contract. All those 5 points were met, but then each of the party has a unilateral enforceable right to terminate a wholly unperformed contract without compensating the other party, right? So without compensating, without giving any goods or services, the contract is terminated, and they have the right to do so. Then entity should not, the entity has not yet, so the contract is wholly unperformed if both of the criteria are met. So they've also explained what do they mean? What are the conditions for wholly unperformed? So they haven't. So the company hasn't transferred any promised good or service. In addition, the entity has not received any money, right? So contract basically is null and void in such a situation, right? So the company hasn't performed any goods or services, and haven't received any money, and the contract is terminated, and therefore no contract exist. So that's what paragraph 12 actually talks about. So if you look at paragraph 13, it's basically paragraph 13 is talking about when do you account for the contract modification, right? So this is about contract modification, and they have detailed guidelines ahead in this time, right? And about the accessibility. So you are not supposed to reassess these criteria unless there's an indication of significant change. So once there's a contract, then you are not supposed to reassess unless there's a further change. Then we have, you can read paragraph 14, then we have paragraph 15, which is when a contract with a customer does not meet the criteria in paragraph 9, right? So what do you do? What does a company do when that criteria is not met, right? So an entity shall recognize the consideration received as revenue only when either of the following events has occurred, right? It's not a contract based on paragraph 9, but entity receives consideration from the customer, right? So this is basically, in simple words, it's basically talking about unearned revenue. So when a customer pays you in advance and the criteria is still not met for paragraph 9, that's basically an unearned revenue for you. And then you can look at this bullet point A and B, where they say the entity has no remaining obligation to transfer. Right, so you only recognize revenue. This is basically saying you only recognize revenue when you have performed all goods and services, no remaining obligations, right? So only then company can actually recognize the revenue, or the contract has been terminated and the consideration received is non-refundable, right? So basically, the criteria for paragraph 9 is not met. The criteria for the contract is actually not met, but entity has received a consideration from a customer, right? So advance payment. Right, advance payment. But the company will recognize that revenue. Initially, it would be unearned revenue, right? So initially, it would be unearned revenue because no services or goods have been delivered, no services have been performed. It's an unearned revenue. But at some point in time, the company needs to recognize it as revenue. So when does that company will be able to recognize that revenue? And that's what point A and point B tells you. That if there is no remaining obligation, then company can recognize as revenue, or the contract has been terminated and the payment is non-refundable, right? So in that case, the company can actually recognize the revenue. This is about so an entity. So paragraph 16 is about an entity shall recognize the consideration received from a customer as a liability, right? So unearned revenue basically until one of the events in paragraph 15. So above paragraph has been met, or until criteria in paragraph 9 are subsequently met, right? So there are basically two criteria, right? So standards are actually very helpful. They actually tell you what you need to do in different business situations. So if you are a financial accountant or you aspire to be a financial accountant for a company, and then you face certain situations, you don't know how to treat an accounting transaction, you can actually refer to accounting standards. And they do give you a guidance on how do you account for those transactions. So then there's a part of combination of contracts, as we spoke earlier as well in one of my earlier videos. So paragraph 17, an entity shall combine two or more contracts entered into at or near the same time with the same customer, right? So same customer is important. You cannot combine contracts of different customers together. Right, that just doesn't make sense. So you will be combining. So you can have one or more contract with the same customer, and maybe those two contracts are similar in nature. So you can actually you can combine those two contracts together. Why not? It's going to save you. It's going to save a lot of time for the company actually. But in order to do so, to combine these contracts as single contract, one or more of the following criteria are met, right? So this is not all criteria condition here as we have seen earlier above. So one or more should be met from ABC. Now this could again be a potential exam question. Examiners can actually ask you. There could be they can give you a situation where there are multiple contracts with the same customer, and they can ask you whether the company can actually combine those contracts or not. It's a simple question, but when it comes to application, that's where it gets tricky. You can of course, since this is an open book exam, you can refer to these criteria during the exam, but at the same time, I mean, there is a time limit. So you need to understand what these criteria are and be able to apply to that situation. That's where the practice is needed. So let's look at the criteria on how to actually, when or in which situation companies will be able to combine the contract. So the contracts are negotiated as a package with a single commercial objective. The amount of the consideration to be paid in one contract depends on the price or performance of the other contract. So you see the contracts are very interlinked. The goods or services promised in the contract, or some goods or services promised in each of the contracts, are a single performance obligation in accordance with paragraph 22 and 30, right? So you have to look at the definition of what is single performance obligation, right? I mean, the purpose of this video is to only talk about the first step, so I'm not going to get into how do you define what is a single performance obligation, but you can refer to these paragraphs 22, 30 to understand what single performance obligation actually means. And I plan to cover this in some of my later videos when we talk about these steps in detail. Right, so if the company meets one or any of this criteria, then it's actually, companies can actually combine that contract as one contract. Right, the last aspect in step 1 is basically contract modifications, right? So there could be contract modifications which is simply changes to the old contract, right? So you need to understand in which case or in what scenario companies can actually modify the contract. So they have defined here the change can actually be in the scope, which is basically maybe, let's say, change in performance obligations, right? So change in performance obligation is a change in scope. Or a change in price, right? So it's either both or one of them that will define as the purpose for contract modifications, right? A contract modification exists when the parties to a contract approve a modification that either creates new or changes existing enforceable rights and obligations of the parties, right? So that's what I've defined, that basically that's the scope part here. Again, it has to be approved in writing or by oral or any other customary business practices of different countries. But then again, I mean, you are in Hong Kong, it really depends. There could be other customary business practices for those contracts. If the parties to the contract have not approved contract modification, an entity shall continue to apply this standard to the existing contract until the contract modification is approved, right? So the standard is actually telling you what to do if contract modification is pending approval, right? So standard is actually telling you that as well. So you just need to basically wait out and apply the standard to the current contract, to the existing contract. That's what they say, existing contract, until the contract modification is approved. Then contract modification may exist even though the parties to the contract have a dispute about the scope or price or both of the modification, right? So this paragraph is despite the dispute, there could be a contract modification, right? That's what this paragraph is talking about. So even if there is a dispute, you still can have a contract modification, or the parties have approved. So basically one part is approved, let's say one part is approved and one aspect of it's not approved. So the parties have approved the change in scope, but there is a dispute of change in price. What do you do in such a case, right? So in determining whether the rights and obligations that are created or changed by a modification are enforceable, An entity shall consider all relevant facts and circumstances, including the terms of the contract and other evidence, right? So basically, you need to understand the whole situation. You have to exercise your own professional judgment or skepticism over there to account for such a transaction. If the parties to the contract have approved a change in the scope, but not yet determined the change in the price, an entity shall estimate the change to the transaction price arising from the modification in accordance with these paragraphs, right? So that's what it's basically telling you. So the standard is just telling you what you would do. You know, it's basically, this is paragraph 19 is extension to this question here. It's just an extension to the question here. So companies can actually, companies have approved the change in scope, but the price is still pending. So the companies can determine the price by referring to these paragraphs that have been mentioned here. Then these other paragraphs, paragraph 20 and 21, right? So if 20 is basically the entity shall account for contract modification as a separate contract if both of the following conditions are present. So again, all the conditions must be met in order for the contract modification to be accounted for as a separate contract, right? So the scope of the contract increases because of the addition of the promised goods, right? So that's part of it. And the price of the contract increases by the amount of consideration that reflects the entity's standalone selling prices of the additional promised goods or services, and some other appropriate adjustments, right? So you can actually read these paragraphs on your own to understand how would you actually, account for contract modification as a separate contract. Then paragraph 20 is if the contract modification is not accounted for as a separate contract, right, in accordance with paragraph 20. So this is also explaining what are the conditions to be met if it's not going to be accounted for a separate contract, right? So contract modification can also result into an entire separate contract. So these are the conditions, right? So contract modifications will be accounted for a separate contract if these two conditions are met, and not accounted for as a separate contract if the below conditions are present, right? So you will have to actually read and apply these conditions in the exam. These conditions here. So you can actually let me know in the comments down below if you would like me to explain these conditions, but you can read these conditions and try to think about these conditions. Try to question yourself, and that's how you would actually build up your understanding on accounting standards. That's how I practice accounting standards myself, to prepare for other exams or in general, right? So you can actually look at these standards, these paragraphs on your own, but I have covered the main part, or expected questions, or what kind of questions examiners can ask you from specific parts of. You find this video helpful, and if you do, please give it a like, share it with your friends, and subscribe to my channel for more videos like these. Thank you very much for watching.